All right. Welcome, welcome, welcome. My name is Brant Handley. I'm Managing Director and founder of Resource Options International, or ROI. We are an executive recruiter specifically focused on the middle market in the USA. And as has been for the last couple of years, every month we've been bringing excellent presenters and speakers to our middle market prospects and clients, and those of you that are perhaps looking to get into the middle market or perhaps into another company in the middle market, great opportunities with regards to learning and building your knowledge base about how to interact in this fast-growing sector. For those of you that don't know, where and what the middle market's all about, it's about 200,000 companies in the U.S. They employ over 50 million people. They currently generate about $10 trillion in GDP, which is about a third of total U.S. GDP, but it only makes up about 3% of companies. So many of them, companies that you've never heard of. Some of them are regional, many are national, but it's in a very exciting sector, particularly with them growing at about 10% or 2 to 3 times the level of growth in the U.S. And every month with these webinars, we bring very exciting folks that come from all over the world that have excellent opportunities and ways in which to share with them. And as you come into the room now, I see Ron's arrived. Welcome, Ron. Tiffany, great for you to join us here. Please let us know that you can hear and see me. Please put a little note in the chat box if you don't mind, and say hello and let us know that you're there. Good morning, good afternoon, good evening, wherever you are. So once again, I want to welcome you. For those of you again that don't know me, my name again is Brant Handley, Managing Director with ROI, and we've got a very, very interesting speaker today. We've got John K. Murphy, affectionately known as Murph. That's the only name I've known for him. Actually, didn't even know his first name was John when we first met. We got an opportunity to meet through a networking group that was out of the New York City area that was involved in connecting people in the middle market. And Murph was a reference for me there, and we had a chance to chat. And actually, I've never met face-to-face, but we've been over the phone and video and many times, and he's been a follower of our webcast. And of course, has recently raised his hand and said, hey, do you think any of your current prospects and clients and folks that watch your webinars might be interested to learn how to sell their own business? And I said, well, that's an excellent idea. Let's put a package together. And well, that's basically what we're going to share today. And I'll bring on Murph in a minute. We got some other people coming in. Welcome, Les. Good to see you, Bernadette. If you want to just put a quick hi in the chat box, let me know that you can hear us loud and clear. Thank you, Bernadette. Thanks, Tiffany. I can see that we're coming through. So a little bit about Murph. He's really built his career in working with medium-sized companies, middle market companies, small companies as well. Really helps them put together, their process for where they go next, in their life cycle. Murph spent about 20 years as an investment banker before he founded J.K. Murphy and Associates, and he and a small team there have been doing an excellent job with helping clients in the industry looking for their next transition. He's known as being very straightforward, and I know that from my own experience. I appreciate that about Murph. Very patient. Has got a very hands-on approach to how he goes about managing that business. And, as you need in this type of an environment when you're looking to, sell a business, particularly if it's a family-owned business or perhaps a privately held business, you need someone who's very patient, someone who can really understand and identify and empathize with the challenges that are involved. We've had a couple of different clients where there have been family businesses, founders that have hoped they could spend or send along their life's work to their daughter or their son, and sometimes that doesn't ever work out, or perhaps the daughter and son aren't involved. And Murph's the kind of go-to guy in that situation that can help companies make that transition. Jeff, I see you've joined us. Welcome as well. If you've got any problems with audio or video, please let me know. So without further ado, the only other thing I'd say about Murph is that he's an avid Green Bay Packer and Wisconsin Badger fans. One of my best friends is also a University of Wisconsin grad, so I know those guys are truly crazy when it comes to football, and I'm sure he can tell you a little bit more about that if you've got some questions as it relates to the football of the Midwest when we bring Murph on in a minute. We will have a Q&A session that will be following Murph's presentation, which should last about 20-25 minutes. However, he'd love to be able to entertain questions as they come in. So as and when you have questions, don't hesitate to put them in the chat box. I'll make sure that Murph gets interrupted as we go so that those messages and those questions can be answered. And then, of course, if time allows, we'll have 10 to 15 minutes to be able to talk about any other questions, particularly a few that have come in prior to the webinar that Murph can handle at that time. Please do wait to the very end. Murph does have an offer for those that have attended. In fact, I think it's a 15-minute consult that he's willing to offer any of you. One of them slots has already been taken. One of our CEOs who was not able to attend but is watching the replay in the next couple of days has already taken the first slot. So I think we'll have 4, Murph, for you. And I'm sure we'll get some activity and some interest on that. So without further ado, Murph, I'm going to go ahead and turn off my video. Welcome you on screen and tell us a little bit more about yourself and perhaps fill in some of the gaps that I was not able to provide.
Hi, everybody. Good morning. I'm Murph here in Los Angeles. I grew up in the Midwest, so I'm living in paradise. And I don't know if anybody can see, but we're 2 days in advance of St. Patrick's Day, and Brant, believe it or not, reminded me that it's close to St. Patrick's Day, which I am ashamed that I didn't realize myself. So I have my Irish tie on today. Oh,
and of course, I totally forgot that about my introduction. I couldn't be speaking to anybody other than an Irishman on a day so close to St. Patrick's. So thank you, Murph.
Thank you. I appreciate the opportunity to talk to everybody today. So I'm Murph. I've spent over 30 years in the financial world, 20 as an investment banker and about 14 as a strategic advisor. I grew up in the Midwest. I'm here in California now and love helping private business owners solve problems. The particular problem that we most usually solve is how to increase the value excuse me, of their company in anticipation of sale or just to have a better performing, more valuable company. So that's what we're going to talk about today. There's a little bit of the rules of the road, so to speak, that I've picked up over the last 30 years, both as an investment banker and as a strategic consultant, and how you can think about your business perhaps a little differently and get it ready for sale. So with that, I'm going to share the screen. So hopefully everybody can see this, but this is our presentation for today. So how many of you have had this kind of circumstance? So a private equity group pings on you and says, hey, we'd love to buy you. Or a strategic buyer says, hey, you would fit great in our product line. Or you've decided that you do want to sell regardless of whether you've been pinged or not, and you want to think about it. You probably have felt that in the last 10 or 15 years, the number of times private equity and more recently strategics have reached out is growing dramatically. A lot of private equity groups, and for those who don't know private equity groups, they're basically money managers. A lot of them are ex-investment bankers or big consultants, and they raise money from public and private pension funds to invest in private middle market growth businesses. They are, by definition, money managers. They are not operators, so they like to team with fast-growing businesses with great management teams, and they are in the business of taking risk. The risk of a new product line, the risk of a new acquisition, the risk of a new accelerated growth story that some private entrepreneurs don't want to take the risk. We'll talk a little bit about that later. But private equity groups and strategics have been canvassing the world quite a bit in the last 10 or 15 years. In fact, we have 4 clients that have been approached directly on a one-off basis by either a strategic and or a private equity group, and they've decided to entertain the discussion. The key for you thinking about that, though, is are you ready to entertain that discussion? Is your company set up? Are you set up personally to think about selling your business or selling a piece of your business to that? And is your company ready to go, so to speak? So those are some of the things that we're going to talk about today. Turning to the next page, a few other things where leads to business for us is you and your partner, if you have partners, whether they're family members or not, are not on the same page. We've received 3 assignments in the last, this is my 14th year of doing strategic advisory work. We've generated 3 assignments simply by one partner telling the other that he didn't want to sign a new personal guarantee on a bank credit facility until they solve where they're driving their business. So that's that has turned out to be a common way that we get introduced to companies to think about their future and what they really want to do, or simply that your growth is outstripping the foundation. You've hit upon a great growth path, and your growth will always outstrip the foundation and infrastructure. So those are all kind of different avenues in which we get involved with businesses and are common amongst many of our clients. By the way, my speaking style is to not cover all the points on the slides, just to cover the ones that are important. But if you feel like you want to talk about one that I haven't talked about, or if you'd like to talk about, have a question about anything I've said, please ping, and Brant will put the question up on the screen. So this is a little bit about us, a little more about us. My partner, who is a process implementation and profit improvement professional, we help companies maximize value. Our idea is we can help you sort of level the playing field if you are interested in going to the world of capital. We don't know your industry like you do, but we know how the world of capital works, and we make a great team in that regard. Most of our clients are interested in maximizing the market value of their company, whether in anticipation of sale or just having a better performing company. Right now, we're working with 12 companies, and all but 2 are going to one day sell. 2 are in the process of transferring the business to their family, so we're doing the work around that objective. The work we do, we believe, has a positive impact on market value, and our cost is an add back for valuation. We're always bringing somebody with us. There's a human capital component to what we do. In the past year, we've brought in FP&A, or people to do financial models. We brought in marketing and headhunters and recruiters. We brought in M&A lawyers, investment bankers, accountants, compensation experts. I just finished doing two retention programs for management teams. One was 9 and the other was 5 for clients that are going to sell one day. And our real message is in the bottom right hand of the page here, which is what we offer is no emotion. We're not in your forest, and we don't have your emotion. We think like a buyer. So the questions we ask you in the preparation that we do is essentially a dress rehearsal for the day that you get in front of them, so you can have more conviction about telling the story for where you're going. So what do we find when we typically get involved through one of the common ways I referenced earlier? The growth plan in your head just isn't working as well as you think it is. You can't hire and keep talented people. That's a big one. Right now, we're working for a client that has lost 3 or 4 key people to bigger competitors. And when we got involved, that was the key reason why he asked us to get involved. And what the key issue was, he had no management team. He had no structure. He had really no management team, and he had no retention program to keep the people there. So that was our job number 1 in helping them think through. The middle screen on the bottom, it's very common for this issue of partners not being on the same page. What that tends to say to us is that somebody's got their foot on the gas and somebody's got their foot on the brake, which really means people want to take different amounts of risk at this stage in their life, at this stage in owning the business. And commonly, the one that doesn't want to take risk maybe ends up selling as part of a transaction, or selling to the one that does want to take risk, as long as the risk is a well thought out program. A dysfunction for family business is common. I remember not too long ago looking at an org chart for a company that had about 350 employees, which is a pretty decent sized company in the middle market. And I asked what this particular person was, who was SVP of operations, and why that person had the title. And essentially the answer was that because he was the brother of the CEO. And as the further we dug into it, he had no P&L responsibility. He really had no managerial responsibility, but it was kind of a, I guess for lack of a better phrase, a face-saving mechanism for putting him in an org chart. And that was an org chart. That was a company that did want to sell. So one of the first things we did is we had to reorganize the org chart to be more realistic, because that wasn't that wouldn't hold water in the world of capital. And then the
Murph,
far right.
Murph, that's a good interjection here. We've got some questions coming in. So
Okay.
I know you want to handle them as we go. And one is
Please.
with regards to family-owned businesses.
Yep.
So Tiffany is asking, what are your recommendations for trying to get all family members in family-owned organizations on the same page when these situations arise? I mean, case in point, the one you just talked about with the brother in that joint. How do you go about handling those differences? Because I got to tell you, I see this in executive recruiting all the time. There are people that have no jobs, big paychecks. They seem to be related, or perhaps a friend of the top executive, and being able to gently suggest that that's probably not the best approach is something that can be quite difficult. How do you handle that in an IB situation?
It's a great question, and it's always a little tricky, but couple dimensions of the way that I think to answer that question. First of all, some of the issues that are in effect being dealt with in that kind of situation are beyond my pay grade. They might be related to what happened in growing up and stuff that I can't change. So I oftentimes will bring in a therapist who and I work with several that have a practice of working with family business owners in this context, because I'm not qualified to deal with the personal side of those discussions. I am qualified to deal with the business ramification of those discussions.
Right.
So that's kind of one dimension. A second dimension is that usually by the time people hire us, they want the truth about their business. So we usually have a pretty wide soapbox to stand on to be able to say, this is where you're, forgive the phrase, where your underwear is showing, and it will involve family. And typically the way that we resolve the issue is to simply say, look, if you don't want to sell your business, you don't have to necessarily change this issue. But if you want to sell your business, this is something that's going to be identified by a buyer that needs to be fixed before you sell. So if you want to sell it, we've got to find a way to resolve it. And then I would go into a discussion about my suggestions of how to solve the particular situation. In the case of the company that I mentioned, we took him off the org chart and found a different way to get him the satisfaction, ego, et cetera, wise, that he was an important part of the company. And therefore, we're able to show a realistic org chart to buyers that they kind of looked at and go, yep, that makes sense.
Yeah. So as a follow-up to that, Murph,
yep.
Do you just take the major shareholders that have the family business and take them aside? Do you take the key leadership owner? Because these things can be very sensitive, right? So in
Yes,
that type of a situation, how do you best approach it?
You've got to approach it from getting as much consensus down the line as you can. And here's the real crux of the issue: whether it's a family or partners, people decide. In the case of partners, what the economic split's going to be. And families, kids, second, third generation, don't often decide what their share is of a family business.
Right.
But the value, the people who create the value sometimes don't relate to the economic division. So let's use an example. Two partners start a company and they're 50-50, and 10 years later, one person is delivering 75% of the value and the other's 25. So these discussions naturally creep up about, what do I get and where am I and what should I have and so forth, as it relates to the idea that the value creation over time generally doesn't follow the economic split.
Interesting.
And as a result, you get these issues and this dysfunction that's totally human nature, and we've got to resolve it. And the best way to resolve it I've found, is to use the facts related to the business and what impact resolving this can have to the value of the company and the realistic reception that the company's going to have in the market. So again, going back to this idea, usually we have a pretty wide soapbox to stand on to be able to say, these are the issues after we do our discovery and our analysis. These are the issues we have to resolve before we go sit in front of buyers. Because if we don't, you're going to be impacted in your pocketbook.
Right.
And
that makes sense.
That's usually a pretty strong, especially again for companies that do want to sell, that's a pretty strong motivator for figuring it out.
That's good. One more question and we'll let you get back. This came in prior to the webinar. How do you keep your objectivity when you may see something that you really know is going wrong, right? And again, maybe it's outside of your financial specifics. You'd mentioned about bringing a psychologist in. I get that.
Right.
But, you know, I can see that, or rather this particular person who wrote the book can see the advantage of keeping that level of objectivity. But, you know, you also have to be able to say, you know, look, guys, you know, 3x, you know, top line sales is just not going to happen. This is why, right? And, you know, how do you kind of handle those situations where, you know, you might have a very strong-willed client?
So again, a couple of dimensions of way to think about that question occurred to me. Number one is, we haven't gotten to it, but there's a slide in here where we talk about the best client for one is one that's open to the idea that we can help. So if we discover in the process of marketing to a potential company that we don't think they're going to listen to what we have to say, not that they have to enact and do everything we say, but just that we're going to be on common ground, that the reason we're there is to make everything better, then we probably don't get engaged.
You back away. Yeah.
Right. So that's one kind of dimension to think about. The second is, you can't, I don't know how to, you can't get blood from a turnip. I mean, isn't that the old expression? I know I always mix my metaphors. So, you know, a company is like a ball. You push in on one side to try to make progress in one place, and it kind of pushes out on the other side and pushes back on you. And that's kind of one of the things that we provide is it's not just this particular issue we might be talking about. It's the totality of all the issues. When we do our discovery, we might come up with 5 places that we need to make improvements. We might also come up with 3 areas that we do really well that we have to do more of and accentuate that in order to create a better growth plan. So what we really do is we try to create a customized growth plan for all the facts and circumstances of our clients. And there's always going to be negatives because frankly, nobody hires us unless if they think it's going 100% as best as it could. We don't work for turnaround businesses. On the same token, we're really working for companies that believe in one way or the other that they're sub-optimizing, that they know there's a better opportunity, whether it's the family, the CEO, you know, shareholders, whatever the situation of ownership is. The reason we get hired is they think it can be better. So the fact that they're open and that they think it can be better, and this idea of that gives us a soapbox, usually gives us the foundation to be able to solve issues. Here's one though that you know, it doesn't always meet the eye and is fascinating to me is we're always brought in by somebody. So in the case of multiple shareholders, especially if there's a contentious shareholder situation, we might be viewed as the other shareholder's person, so to speak, because that's just how we found our way to the company through referrals. So the way we have to preserve our objectivity in that is to say to the person who found us through their trusted advisors, you know, we don't know what we're going to find. So we have no idea what we're going to say. Believe me, you may think we're going to say one thing and don't think that we're going to say what you want to see happen in the company. We have to, the reason you're hiring us is to help you decide what's the best path from here. And the way that we keep objective is that the way we talk to the company and the issues we give them to work on are truly based on our opinion of what a buyer is going to care about. And if we have to use anecdotal evidence or even references from other clients for the same issue, most all issues that we've faced, we've run into somewhere in the past.
Right.
So, I mean, we haven't seen everything, but we've seen in 33 years, I've seen a lot. And we usually have seen it before. And as a result, we usually have at least one way to solve the issue. It may not be right for this particular situation, so we have to come up with an alternative, but that's how we try to preserve our objectivity.
That's great. Murph, I'm going to let you get back. Jeff did have a comment, and it was a very astute one. There is no point in having experts if you don't rely on them, right?
Exactly.
Enough said.
So I have a great story about that. The first month that I was doing this back in 2004, I had a client that had a particular moment, you know, was completely ignoring everything I had to say. And I was frustrated by it. And I was brand new to this role. And I called my lawyer, who's one of my trusted advisors. And he said, this is what you do. He said, you write an email right away, save it, wait 3 days, and then delete it. And that's what I did. And that's what happened. And so sometimes there are people who hire you that won't listen to what you have to say. But I think we're much better about weeding that out in the marketing process to make sure that the people we end up spending time with are the ones who are open to the idea that they want help and that we're the ones that we're part of the ones that they're going to get it from.
Good stuff. All right, please continue.
So here's so we've talked a little bit about the places on which we get hired and what we find. And here's a couple of pages of what the causes for what we find. And again, I don't want to, I missed one. Let me just go back. I can go back, right? Can I go back?
Yeah, you should just, I think, just hit the arrow the opposite direction.
And my arrow's not coming up for some reason right now.
Okay.
Yeah, for some reason it's not coming up.
Kyle can get in there and help you.
Kyle, can you help me on this one?
He said there should be, if you could push the left arrow key.
Yeah, the arrow keys aren't coming up on the bottom left right now for some reason.
What about on your keyboard?
Oh, how about that? Technology at its best.
Thanks, Kyle.
So, thank you both. So one thing I want to cover is this bottom right comment of all revenues not created equal. I find a lot of business owners suffer from that revenue is created equal, and that's not the way the world of capital typically works. Let me share with you examples. So when companies are first starting out, all revenue is created equal. All that matters is revenue to get a foothold, to get a market share, to get going in the world. But once you get more established, all revenue is not created equal. We had a company that was a for-profit school, and it was run by artists who had created a career around what they did as a living. When they started, there was no career. So they created a school to help people in this regard. And what they would do as artists is they'd add new courses every quarter because they wanted to expand the breadth of everybody's horizon. And so they would find curriculum, they'd find teachers, they'd take down, there was a capital cost, they'd take down space. And what we told them is, after looking at the business, we said the best revenue for you is the last 10 seats in every classroom, because you have absolutely no more cost related to those seats. And the revenue that you get from them will literally fall to the bottom line, which, by the way, I've heard that phrase fall to the bottom line a lot in my career. And it's not too often that it actually does happen. In this case, it did happen. And so what we agreed on is that they wouldn't start any more new classes until each current class was up to between 80 and 85% filled. And it almost overnight transformed the business from roughly break even to a very decent EBITDA multiple or percentage business, simply because they incorporated this idea of all revenue is not created equal into their business model. So we find that a lot with companies, particularly in distribution, where it's all about volume, that value doesn't necessarily follow volume. So I just wanted to make that point because we find it, it's a common one we find. So
good point.
Why do people run into these things? Well, most of our clients don't do a lot of planning or forecasting, which is the whole point of us getting involved. Essentially what we do is we help build customized growth plans to meet the objectives that owners have. So we find out what the objectives are, and we create the forecast and the plan that will accomplish those objectives and create as much value along the way. Most of our clients don't do a lot of planning. And the reason I started this a few years ago was that most of our clients compete against larger companies, whether public or private equity backed. And those guys are all doing planning. So our clients need to do some planning. We find often that a common mistake is no one ever says no in sales. They don't say no in growth initiatives or in sales. So picture yourself in your garden throwing a lot of grass seeds in your backyard. And you can plant a lot of seeds, which are pretty cheap to do, but the key is, is it gonna grow? Do you have time to nurture those seeds and make them grow into beautiful plants? And oftentimes in the analogy of business, I find that people spend too much money on growth initiatives and they don't end up with a good looking garden, so to speak. If they had pared back and focused on the best growth initiatives, not all the growth initiatives that they could fund, they end up with a better result. So oftentimes what we help them do is set up the criteria to judge one growth initiative for another. Again, this idea of if they're all successful, that there's some revenue that's better than others. And you end up with a better revenue stream, a better cash flow margin, and a better, more valuable business. One of my first consulting clients was one of my last investment banking clients, a gentleman in the footwear business. he used to made a business out of buying the brands that nobody else wanted. And the way that he did it is he bought only the revenue he'd want. He'd go in and analyze all their revenue, and he'd only buy the revenue that he wanted. So he was very smart about that. All revenue is not created equal. We talked a little bit about emphasizing growth over profitability, and a lot of times, especially for companies that do want to sell one day, you need to be focused on adjusted EBITDA, which we'll talk about later. Generally speaking, that's a key metric for most companies to be valued. And many times, clients don't try add backs, which is part of the getting to adjusted EBITDA. Is the things that private business owners do that wouldn't be the case if a new buyer owned the company, particularly an institutional buyer. Things like non-essential family on the payroll, personal expenses, excess owner's comp. Those are all legitimate add backs, because the goal is trying to find what the true operating cash flow of a business is for somebody else to buy.
Murph,
so those are some.
We got a couple of other questions that are kind of on this. So let me get it out to you. One of the questions that came in is, kind of what's the general, timetable you would recommend, right, for organizations to kind of start and complete the process? What they should be thinking about in terms of selling their business.
The longer the better, but I'd say if you have a year to 2 years before, that's pretty good. The key is we don't know what we're going to find and how long it's going to take to refine or fix it. So the earlier the better. Let me give you an example. We oftentimes up-tier or replace the finance function in our clients in probably 2/3 of our clients. So the longer time we have, why? Because they just aren't up to snuff to what is going to be needed once we go down this path. And part of the value we're also providing is I've been through this drill enough. We know what's ahead, and many of our clients don't. So trying to anticipate what's going to be needed in terms of management is really important. In fact, my colleague, Jack, tends to work on the process, workflow, efficiency, improving the profitability from that point of view. And I tend to go bigger picture of how good is the management team, how good are the numbers, how good is the strategy, and improve it from that perspective as well. And the management team is critical.
Right.
It's critical. I was talking to somebody yesterday, a new prospect, and he said, so what's the most important thing, that I can focus on? And I said, management. If it's one thing, having great people can sometimes be the solution to many things. In fact, the things that I've seen create the most value in the last 33 years hanging around the hoop in the financial world are finding and keeping great people, focus, great numbers, having solid numbers behind you, both in terms of historical and spending money and accounting and finance, and using risk-adjusted rate of return, looking at things on an objective return-based basis. And then lastly, conviction. I find that the more conviction owners have about where they're going, the better price they get.
Absolutely.
Part of what we try to work on as well.
Can't agree with you more about, number one challenge and opportunity is to have good, strong people.
Absolutely.
I need you to talk to some of my prospective clients, Murph. But I did just everyone on the page. I did not set them up for that.
No, it's the number one thing. They say real estate's location, location, location. This business is all about people, people, people. How good is your management team? And you probably see it in spades, Brand, but a lot of owners don't want to hire people that are smarter than them. And that's the opposite. That's just the opposite of what you should do. You should have to work at keeping great people. That should be if that's your number one priority is to keep great people, then you're in a pretty good situation, because that means that they're really good. They have options, because really good people have options, and figuring out how to getting them and figuring out how to keeping them is just really, really important. Did you have another question there?
Back to you. I've got one, but we'll fit it in a little bit later.
Okay. So a few more causes. Poor finance. The easiest way to get in trouble in selling your company is to not have great numbers. And conversely, I've never had an owner or a client, and many of them become friends after the work that we go through and the adventure that we're on, the journey that we're on. I've never had somebody come up to me after they sold and said, damn it, Murph, I spent $100,000 more than I should have in finance, and I wish I hadn't. It's never happened. you can never, I believe, I know I'm spending your all's money as CEOs of your own business or owners of your own business, but you will never go wrong spending money in accounting and finance. And most owners don't start there. So that's really important. What do I mean? I mean quality financials. I mean getting monthly numbers on a timely basis that are accurate. Because when you're in a process, you're going to have to deliver monthly numbers that are accurate. Having practice doing forecasts, not just 1 year through a budget, but out a couple years. Because it's the process that we take people through to get a 3-year projection that's almost more important than what's ended up being written on paper. It's the idea of thinking more longer term about their business and what are all the variables that we need to include in something like that. Another big one is people processes, institutionalizing it. For companies, I don't want to put a revenue range on it, but for companies that are, a lot of companies have the owner dominates the business. They cast a wide shadow across the business. They're in charge of all the relationships, or at least the major ones. They make all the moves externally in the company, outwardly facing. And those companies tend to take a value hit because many times buyers will say that you're too important to the company and what you bring to the table hasn't been institutionalized into the company through process, people, and procedures. So that, God forbid, even if you were hit by a bus before you sell, that the company would survive and prosper in your absence. So that's another thing that we work on, again, through people, having great people, building a management team. We're working with a client right now that he lost a couple of big people. I think I referenced it earlier, that we're helping him build a management team. Well, we took 2 or 3 months and kind of dug into the company, and we let 2 people go, and we promoted 3 people from within, and we've created a whole new management team. We announced it 2 months ago, and we were visiting with the owner yesterday because now we've got a second phase of our work that we're doing with some individual development plans for the people that were promoted. And he's just happy. He did everything in the company, and in order to accomplish his growth plans, we told him he couldn't continue to do that. And we've started to finally, the hidden agenda for him, the overt agenda was he needed a management team to scale the business. The hidden agenda was he's now institutionalizing everything he used to do. We had made him for 2 weeks write down everything that he did, so we have a really good sense of what he was doing. And now we've figured out people to offload that on. And so he's spending time offloading and institutionalizing what he brought to the table for this company for running it for 20 years. That's really important because buyers always love to find excuses not to pay the best price. And the more things that you can check off the list that yep, we got that covered. No, they can't use that as an excuse. Doesn't mean they won't try, but it means that you should, through a good process, be able to overcome that by talking to more buyers because we know it's covered. So quickly on the next page, who are our clients? I've been talking a little bit about this. They're open. They're all private. They're family, entrepreneur, individually or partner owned. They're generally range from sort of 5 million to 200. The sweet spot's probably 20 to 100 million in value or revenue. It's companies that are established typically, although we're seeing a lot more emerging growth companies that just in the last couple of weeks, I've met with a number of companies that have one business that they're doing and they have a related business they want to kind of start up from scratch. But they're generally more established business and they're all privately held. We are not industry experts. We're not an industry expert for any client that we work with, but we have a lot of investment and exposure and time spent in various industries. What we say is, we know the world of capital, you know your industry, and together we make a great team. We'll never know we'll never know your industry as good as you do, but we do know how the world of capital works and what buyers look for. And so that's when you're at that stage, that's what we work as a great team. So this is
Murph, quick question. This fits into kind of that area. How do you know when it's the right time to sell, right? A lot of our CEOs and prospects, people that are attending, they may have been involved with the company maybe 20 or 30 years. I know there's one CEO that, was part of the founding family, now sits in a chairman role. And, he and I have had conversations in the past about, gosh, not sure exactly what the right time is, but, at some point in time, the family's pretty much out of the business. We've got some professional managers in, but, kind of getting a compass on,
Sure.
What is the best timing there? Any kind of general, and I know every situation is going to be, specific, and obviously it's hard to maybe answer that in a general way, but are there some milestones? Are there some areas that you can help the audience with in terms of understanding? And again, if you're approaching it later on, don't let me interrupt the flow.
No. I just went to the page. Thank you. So these are some rules of the road that I've learned. And the upper right is always sell or raise capital when you don't need to, because you get a better deal. So how do you refine that in? Run the companies if you're not selling. We had a company that's a regional based manufacturer because the product they make is heavy, so you can't truck it very far. And we decided that the next wave of growth for this company needed to be a different market. And it was a de novo, organic startup, essentially from scratch. And when they created new plants, it took them 5 years to get to profitability. It's just the way the business ran. In the third year, they decided to sell the company. So this new project was running still at a loss. And so we insisted that whoever bought the business pay full value for that business, because they were going to get the benefit of this new growth market as long as they own the business. And they shouldn't handicap us just because the particular year we decided to sell that part of the business didn't look very well. So in that case, we were doing the right thing by running the company as if we were not selling. And oftentimes when I get questions from owners as we're in a pre-transaction planning process and they say, what should I do? The first way I usually answer it is, if we weren't thinking of selling, what would you do? And many times that's the right answer. As it relates to the specifics of it, it really depends. Sometimes people have a number in mind, Brent. Sometimes, well, everybody usually has a number in mind. Whether it's realistic or achievable or not is the $64,000 question.
Right.
Sometimes people have time frame in mind. I worked for a guy 3 years ago that his number one criteria, which drove our entire planning process, was he wanted to sell by 33. So it wasn't money, it was a time frame. And I speculated on why it was a time frame, what was the magic to 33, but that was the number.
Huh.
The best time to sell from the buyer's perspective is when there's enough juice left in the tank. You can't have, if you've SERPed all the growth, if you've absorbed all the growth possible for your business and then want to sell, people figure that out and they won't give you a great price for your business. So One of the other ingredients is always sell when there's enough through the windshield going ahead into the future that buyer and a legitimate businessman or businesswoman can say, yep, yeah, that makes sense to me. There's growth left here. Some owners think that they're going to hit a negative they try to portray a great picture of how rosy things are. And then the buyer's going to say, well, why are you selling now if it's so rosy? They always do ask that, but they're only asking it to get a flavor for you. It's a totally legitimate reason to say, I want to take risk off the table, or I want to spend time with my family, or whatever the other issues are. And so, but selling when you have growth left is always better than when you don't. And then lastly, it's personal. I work with a husband and wife that own a business that have expressed to me every time the subject come up that they never want to sell, and they had a close family member suddenly die, and it's changed all their calculus. So you just never know. Many times oftentimes it's more the personal situation than it is the economics. And then the last one is timing. We've been in a 9-10 year bull market, and everybody's kind of looking at their watch saying, everybody that I know is looking at their watch saying, how much longer is this going to run? Sometimes owners are like, well, maybe it can't last forever, so why not get out now? So it really runs the gambit of all the different reasons that I mentioned, and probably mostly it's a combination of some of those in almost every case.
There's a follow-up to that. One of our panelists, our attendees said, what are the one or two worst times to sell? Or worse reasons, I guess.
The worst time to sell is that you have to, because you've waited too long, and everybody who you're going to talk to knows it, either because they know it in the marketplace competing against you, or they know it when they see your numbers. And, like, I don't know if anybody's been following Toys R Us. Toys R Us filed bankruptcy, but I'm sure they had conversations along the way to see if anybody wanted to take it off their hands. And, I'm guessing nobody did at any price, because it was just a sinking ship. So never, the worst one is to wait too long. The other one that's not so great, although it can be realistic, is, you look down the road and you see things, you see your ability of your company not to compete. because you have to keep up with the Joneses. Let me give you an example of that. So the largest company I've ever worked for was in a different state. And part of the reason why he hired me was he didn't have anybody to bounce stuff off. Nobody told him if he was doing a bad job, because the whole constituency he was the biggest employer in that part of the state, and it was a family company, and the board was his mother and their lawyer and his sister, and nobody gave him the straight scoop, or nobody had an incentive to give him the straight scoop. And and he said, my goal is to pass it on to my children, just as my dad passed it on to me. And the first question I asked him when we were together, I said, do you care about the market value of your company? And he said, no, I don't care about the market value of my company. And I spent the next 3 hours in our first meeting trying to convince him that he should care about the market value of his company. Because if he's not going to make the decisions that his competitors are, because they do care about the market value of their company, most likely. And he may fall behind the 8 ball related to that. So it's just the way I calculate that sometimes business owners aren't taking risk. And it's our job to tell them that they should take risk. And that by not taking risk, they're actually taking more risk than they think they are, because they're not keeping up competitively, perhaps they're not adding that product line. They're not building that. They're not risking more capital that the facts and circumstances of their business or their position in the industry require. So that's a pretty good time to sell. In fact, the whole private equity industry grew up around this idea that there's some private business owners that don't want to take the risk anymore. And because they have 90 or 100% of their net worth tied up in the company, at some point they want to risk off, and yet they still have a pretty plausible business. That's why private equity came in, because they're totally incented and set up for taking risk, hopefully measured risk. But nonetheless, that's why private equity has grown up, because it doesn't take a genius to realize that they get 2% generally of the management fee of the money they raise, and they get 20% of the upside. So they definitely want to go for 20 more than 2. So they're paid and incented and asked to take risk and put their money to work. So that's where this idea of risk comes back to discuss. That's how private equity grew up. They're willing to take the risk. I had a client that similar to I mentioned earlier. It was 2 shareholders. They'd been together forever. They'd known each other since college. And one of them finally said one day, I'm not signing the new personal guarantee until we figure out what we're doing. And I was referred in and realized that it was a function of this particular owner didn't want to take risk anymore at that stage in his life. And yet there was a real significant, legitimate growth opportunity. So we sold the company to a private equity group. They retained about 20% of the business. And the private equity group over the next 4 years increased the size of the business by 10 times. Because in fact, true to form, there was this significant growth opportunity that for good and valid reasons, one owner didn't want to participate in. And so essentially the owner that did want to participate changed out his partner to one that did want to take risk. And they made more money at what they call in the private equity world, the second bite of the apple, than they did in the first bite of the apple, because they teamed up with a partner who was willing to take more risk. So a lot of what we do is help engage directly and indirectly around this issue of how much risk owners want to take at this stage in their life, at this stage in the life cycle of their business that they own, and how, and everything that relates to competition and so forth.
Good.
So hopefully that helps.
Murph, quick time check. We got about 10 minutes left to the hour. So if you want to get back to your slides, we've got a couple other questions that are probably good for the end, but just to kind of keep you back on track.
So just to real quickly back on this growth story. So there's a personal column. How much risk do you want to take? I think I've talked ad nauseum about that already. What are your personal and financial goals? How much net worth do you have outside your company? Do you have a number? So we study and get information in our facts and kind of learn our clients' needs and objectives related to that. What's happening in the market? That's another factor. What's happening in the market right now? The M&A market is very, very strong. It's stronger than it was before 2008. Everybody's kind of looking around their shoulder, wondering when it's going to get knocked off its perch, but it's still very strong. And the economy seems to be doing stronger. I've been doing this for a long time. The economy seems to be pretty decent. It has finally seems to have reached its recovery after the 2008 downturn. And then the other place we gather information on as relates to the company is what are the realistic growth options? What are the required resources to achieve those options? People, technology, capital, execution, strategy, and then come together. Those are the ingredients that come together for the customized growth story. We talked a little bit about value quite a bit, so I thought we should explain it. Earnings before interest, taxes, and depreciations, or EBITDA, plus add backs. Those are the things that I mentioned earlier that private owners do that other institutional owners typically don't. Times a multiple equals total value less debt. So you pay off whatever long-term debt there is, you keep the cash, equals equity value, which is what shareholders split and pay taxes on. That's generally some industries have very specific monikers of attaching value other than cash flow, but generally this is the key determinant in cash flow. So you can see right away, anything that you do to increase EBITDA or increase the multiple will increase your market value. So what are those things? They're kind of the opposite of the things we've already talked about. You know, I won't go through all these, but having great management, reducing the companies dependent on you, having good momentum in terms of size, market share, et cetera. So size matters. Size of your business matters. Typically the size of your EBITDA, specifically in the private equity world, is, are you a $5 million EBITDA? Are you 2.5? Are you 2 million? Are you 10 million? Most of the private equity world divides itself by how, you know, when you talk to a private equity guy, he'll say, we invest in consumer businesses 5 million and above, meaning 5 million of EBITDA. They segregate themselves. So the world is segregated on size, unfortunately, and bigger is better. I don't always agree with it, but bigger is better. So a lot of times we're helping our clients decide, should we grow it for a while and get to another size threshold and then sell it? And what's the execution risk of that? Or should we sell today at a smaller EBITDA and call it a day and not have to suffer through the execution risk? So that's a common question that we ask or that we're asked to help answer. All revenue is not created equal. We talked about that. Industry size and transaction history. So when people try to chart, when investment banks and buyers try to chart your business and talk about how valuable it is, one of the things they look at is what transactions have occurred in your industry space against companies that are generally referred to as your competitors. And that gives everybody a guide as to what your company, so then what they do is they compare your company to those companies and decide, should you have a higher multiple or a lower multiple? It's something that that everybody does. And one thing we didn't talk about, revenue concentrations. So revenue concentrations affect risk and they affect financeability. So the private equity model, as many of you may or may not know, uses a lot of leverage in their transactions. It has a particularly dramatic increase of return on equity. And it has, in the case of, it does have a downside, like in the case of Toys R Us. If Toys R Us didn't have as much debt on it because it was bought by 3 private equity groups right before the peak of the market, or they bought at the peak of the market, it probably could have survived better if it didn't have as much debt, but they loaded it up with debt. So there is a downside to that. And lenders and buyers don't like revenue concentration. So that's something that we always work on with our clients is, what does that look like today? And can it change over time? Other value drivers, I'll just pick a couple. Visibility. Every management team that we start with says, we can't forecast our business. And we say, yeah, you can. And there is a way. We just need to work a little hard to figure it out. So the companies that have visibility on revenue and EBITDA, i.e. like recurring revenue models, tend to get higher prices. Why? Because it's visible, it's predictable. The more predictable it is, the better off it is. And then lastly, one thing I'll talk about is scalable. So scalable growth stories are where, as you grow, your margins increase because you don't need to add as much fixed cost to your infrastructure to grow the business. Obviously, a SaaS model has imminently scalable because that software product doesn't care if 2 people or 10 million people are using it typically. So that's scale. And the best prices are paid for companies that have scalable growth stories. So that's one thing we're always trying to figure out is this scalable and how scalable is it? So we talked about market value guidelines, just a little bit about current conditions. It's hot out there. We had one company sell last September. We had one sell in December. We're hiring an investment bank for one right now. We hire about 2 to 3 investment banks a year for our clients that are ready to sell. We don't do the transactions anymore. We hire the banker because they provide, in most cases, they provide a lot of value. And it's generally our sort of MO. It's hot. There's a lot of private equity money. I've noticed 2 of the 4 direct inquiries that our clients are working on from one buyer are strategic, which is higher than it's been in the past. Strategics are really starting to play ball with private equity and being very outwardly driven to find opportunities to grow their business. Where we come in is we believe, and we've been told by private equity groups and others, that having a business that's ready to go is worth at least a turn of EBITDA. So that can be a big value enhancer. And generally speaking, most private equity groups and strategic buyers, the attractiveness of your business is not only the product or service you provide, but the management team you have. So that goes especially in the private equity world, because they're not operators. They need managers by definition. Strategics may feel like they have their own managers, but putting your money where your mouth is in terms of your management team, I don't think will ever go on.
Quick question on that. What industries are the hottest businesses coming from?
Well, cosmetics is really hot. Anything to do with cosmetics, hair care, skin care. Skin care has the second highest margins in that whole space to perfume. I've worked with skincare and cosmetics. So those consumer-facing businesses that are e-commerce driven, that have their own website and get a significant portion of their revenue from their own website are hot. The IT services businesses, regardless of the industry, whether it's healthcare, et cetera, is still hot. Anything related to IT, anything that's scalable. Any business to business that's B2B that's scalable is great. And then for any consumer facing business, the more business you have on your website, the more valuable you'll be.
Right.
So I advise clients that are consumer facing to reinvest in their website, because it's the best way to drive more value. The margins are higher. You control the experience of the customer better, because you can't predict how good the salesperson in whatever retail store that you sell your product to is going to, what kind of customer experience they're going to have. And obviously you give them a 50% discount typically. So in fact, we have a client right now that the big change we came up with in their strategy was to go 100% direct to consumer and get out of not only wholesale, but other wholesale in terms of brick and mortar, but also other wholesale that were other e-tailers where they were giving the same discount. Because we got involved and they had been thinking about it a little bit, but we said, why are we giving these other e-tailers a 50% discount to compete for the same customer we're trying to find online? I understand when you started a number of years ago, that might make sense, but today, let's really examine that. And we did, and we're converting up to 100% direct to consumer. So I see the internet even more powerful now. I don't know what everybody feels, but when the internet first came out in like 2000, 1999, it was like, oh my God, the end of retail. And all these internet stocks were going crazy. And I remember being in equity committee meetings and, we had to price this stock at this revenue multiple of 5 years out because that stock was priced at it. And it was just crazy kind of mumbo jumbo, money. And then the downturn came and everybody's like, no, the internet is going to be important, but it's not going to be the only way to distribute products. Well, cut to 15, 16, 17 years later, it's really important.
Yeah.
For any consumer-facing business, it's really important. And so any consumer-facing business, the more you can have on your website, through your website, the better off you're going to be in just so many different dimensions.
Murph, we're 2 minutes to the hour, and we like to keep these to 60. I know you're on your company page, which is great. There's a last question that I think you can cover on this, and then we can, talk about your offer to the folks here. It's a 3-part question. The average length of your engagement. How does JKMA bill, retainer per hour, per project, success fee? And then lastly, how do your clients measure your success, right? What are the metrics and deliverables that they use? I know that's a loaded question, but in 2 minutes, if you can answer that, that'd be great.
Sure, I'll try. Average assignment is probably 2 years. They range from 6 months to 10 years. I've had 2 that were in the 8 to 10, actually 3 in the 8 to 10 year range. It just took a while to get all the plans together to sell. But most of them are in the 2 to 3 year range where we're doing maybe a year of prep, a year of the hiring a banker and the process. It takes usually about 6 to 9 months for once you get a banker involved to complete a transaction, towards 6 months in a seller's market, which it is today, and towards 9 months or longer in a buyer's market. So that's kind of if we have a year to make, if we get involved and we have a year to make changes, that's usually good. Sometimes it might be better depending on how much change we need to make. But if we have a year and a half to 2 years ahead of, that's great. How do we get paid? We charge an hourly fee for our time, and we ask for a percentage of upside. The way that we get the percentage of upside that it seems to be most resonating with owners is we value the company when we get started, or we agree on a value. So all that's our clients. And then we negotiate a percentage of the increase that happens, that's measured by whatever the transaction is whenever it happens. So we're not equity, we're not warrants, we're not distributions. It's just, we simply get a piece of the upside.
Great.
And what was the
last one was metrics. How do they measure your success, your contribution, the deliverables?
Increase in cash flow, number one. Number two, increase in culture. How's the management team and the company reacting to paying more attention to the P&L, paying more attention to EBITDA? Typically, our clients don't pay attention to EBITDA. You have other objectives in mind as you're growing your business, and then your objectives change. Your objectives change as saying, I want to sell my business. So the strategy and tactics that you use have to change too. And sometimes management people can't make that change. Sometimes they can. But it's generally increase in the value is how they judge us, or increase of cash flow. And because the value is also the cash flow plus the multiple. So we can get multiple expansion by the growth story that we help either create or execute on. So, and then the last place that they look for is how well, I guess it's the second one, is how well is the management team doing in the new environment. Right. I work right now with a company that's 40 million in revenue, and they hired us last year, and they had a great year in 16. They had a so-so year in 17, and now we're kind of rebuilding the company, and we're engaging the whole management team, who are all now part of a retention program, to manage the business in a way they've never managed it before, and they're loving it.
Awesome.
I've been surprised. They it's not, many of them aren't financially oriented and haven't run a P&L before for their team, but it's turning out great. So I'd say the biggest one is value increase.
Yeah. Murph, we're at the top of the hour. If you wouldn't mind, flip ahead to your last slide. We know everybody's hung on here and obviously wants to get in touch with you. And again, I'm sad to say that there are not 5 positions. There are 4 positions. I think isn't your last slide?
Yeah. So I'm just running through. My colleague Jack is a GE black belt in Six Sigma from GE and Accenture. So he goes low and I go high, as we mentioned. Michelle is a strategic planner for the CPG industry and works with us on those CPG opportunities that we have. And then lastly, for the first 5 people, I guess one's already taken. I'd love to spend 15 minutes on a free phone call with you to understand if there's a way we can help, or just give you little tips about where we see you might get you better on course. And I've really enjoyed it. It's always great to get questions, especially in these webinar formats.
Absolutely.
Where you can't talk directly with each other. It's really awesome. So thank you all for your time and for your questions, because it's much better to have a dialogue than a monologue. So thank you.
Well, Murph, thank you as well. And again, for those of you that want to take Murph up on his generous offer, you can email him directly, jkmurphy@jkmurphyadvisors.com. You can email me, Brant, at Go4ROI. I'd be happy to pass that along, or give either of us a call. My number, 805-455-2702, and I could be more than happy to give you Murph's direct line as well. So once again, Murph, thank you so much. This is great. I'd love to have you back, maybe in about 6 months. I think we've had great engagement here. One of the things I think that our clients and our prospects really enjoy is, case studies, and might be fun to, anything that's not too confidential, maybe walk through, kind of the beginning to the end of what, your process looks like. Take a couple of different clients to look at it. We'll go out to the market and talk to some of the folks that attended and see what they want to hear less. But this has been fascinating, great engagement. Once again, Murph, thank you so much for your time on behalf of all the folks that attended today. And those of you that are watching this as a replay, please also do reach out to Murph. We're not sure if all of those positions will go, but for obvious reasons, he'll be available to also engage with you if you're watching this on a replay. So thanks again for all that attend. And once again, Murph, thanks.
Thank you, Brent. Happy St. Patrick's Day to everybody.
Well, happy St. Patrick's Day. Bye for now.